What is a stock split? A stock split increases the amount of shares but lowers the price per share. But it keeps the total value of the shares times price the same, aka market cap. So let's give you an example. Let's say Tesla. Let's say their stock is now at $1,000 per share. And let's say the market cap is $1 trillion, for example. Now, if Tesla undergoes a 10-for-1 split, this means that for every 1 share, you will receive 10 shares. So, Tesla's price will correct to $100 per share, and the market cap would be $1 trillion, right? And the amount of shares in circulation for the first one was 1 billion shares. Not in circulation, but like the market cap would be $1,000 per share times by 1 billion shares to get $1 trillion, right? But now, since the share price corrected 10 times lower, then the amount of shares, as I said, if there's 1 share, it becomes 10 shares. So the amount of shares would increase to 10 billion shares. So the market cap is constant, but the price and the amount of shares change. So companies do this to make their stock more affordable to other investors. Like, for example, not everyone has $1,000 to invest. So excluding fractional shares, these investors would now be able to invest in Tesla at $100 per share. And so it opens up, first of all, more investors can invest in Tesla, and second of all, it provides liquidity to the market as more shares are available to be traded, which can improve liquidity. There's also a reverse stock split. It's basically the reverse of what is done here. So when Tesla does this split, it's usually because they have high growth. It shows that their company's share price is going up a lot, and it demonstrates that the company's growing a lot. Well, on the other hand, reverse stock splits are done with companies with low growth, and they're usually done, aside from the exceptions, they're usually done to obey the exchange's requirements. Let's say for the NYSE and the NASDAQ, you need to maintain a $1 per share minimum. For NYSE, so the New York Stock Exchange, and the NASDAQ. And so companies that fall below this, they're given 30 days for their share price to increase, or else they will be suspended or delisted. So I'll give you an example of a reverse stock split. Let's say there's a stock, let's say Tesla again. Let's say for whatever reason, it's trading at 50 cents, right? And let's say there are, for simplicity's sake, let's say there are 200 shares in this company, for simplicity's sake. So the market cap would be $100, because market cap is the price per share times by the amount of shares. These shares are not just the ones that are being traded. These also include like private equity shares, or shares that are not like available through exchanges. So if you do a reverse split, let's say Tesla undergoes a 1-for-2 reverse split. So this basically means that for every 2 shares you have, you will be given 1 share. So in Tesla's case, first of all, the amount of shares of Tesla would decrease to 100 shares, as it's a two every 2 shares it becomes 1 share, so the amount of shares in circulation become halved. So 100 shares and the price doubles because the market cap would be the same. So look at the market cap. The market cap is 100, the market cap is 100. These splits don't change the market cap. They change just the price of the shares and the amount of shares available, usually to follow the exchange requirements. So now, Tesla at $1 would be obeying these NYSE and NASDAQ regulations. Now, what are dividends? A dividend is like a portion of a company's profit that you give back to the shareholders. So it can be either in cash or stock. So cash or stock. So these are the two types of dividends, the common dividends. So for example, let's say stock. Let's keep it at XYZ. Stock XYZ is currently trading at $100, and let's say they announce a special dividend of $2 per share. A special cash div. So, after this announcement, XYZ would immediately change to $102 because those that have this stock before the X dividend date, which is something I'll talk about later, get $2 more on their investment. They get $2 cash per share. So this is the $2. The 102, this is the $2. And what I was saying is the X dividend date. So the X div date. So the X dividend date is basically the cutoff before the new it's the cutoff date before new investors after this date. New investors after this date won't be able to get the div. So let's say for XYZ, the cutoff is January 1. So on January 1, stock XYZ, on January 1, stock XYZ will correct back to $100. It will correct back to $100 because the new investors can't claim the $2 dividend anymore. They can't claim this $2 dividend. And after the X div date is the payment date. The payment date is basically when the investors get paid. But the investors won't even get this exact $2 because there are taxes. It's called dividend tax. So a stock dividend is basically the same process, but the company gives you stock. So for example, let's say company XYZ. Let's say it's trading at $100 and they announce a 100% stock dividend for whatever reason. This means that on the next day after this, the stock price would adjust to $50 because assuming that market cap is the same. So you need to remember this. Market cap is the same. Assuming like the other market forces, like the speculation on the stock, assuming all those other factors are constant, the market cap would stay the same between these dilutions. Let's say there were 100 shares here, and now there would be 200 shares because of this 100% stock dividend. So it's basically the same process. The market cap is still at $10,000 in this example. Okay, now I'm going to be talking about how do companies raise more cash? Well, there are many ways, but I'm going to focus on FOOs and SROs. So let's start with FOOs. FOOs are follow-on offerings. Follow-on offerings basically happen when the company sells new shares to the public after it goes public to raise capital. The FOOs dilute investors because their shares would stay the same. They would have the same amount of shares, but the price of these shares would go down. Basically, FOOs happen when a company decides to issue new shares and they sell these to the public for raising capital, to raise capital basically. And the key point here is that it increases the share supply. So FOOs raise money through the company selling the stock. So let's say company XYZ is going to participate in an FOO offer. So let's say if it's trading at $100, the company might say that they're going to sell 10 million let's say they're going to sell 10 million shares at $99. And these are newly issued shares. So this is open to the public to buy. You know how I said it was diluted? This is only the case if the company issues new shares. Because companies can also get their reserve shares, like from company buybacks, and they could use this as the shares that they're going to sell. And they could sell these reserve shares instead of adding new shares for the company to sell. So after this is open to the public, the company would then get these proceeds that they make from this FOO, and they can use it on expansion or whatever business venture or growth they're going to plan on. So now I'm going to talk about SROs. Now SROs are shares rights offerings or stocks. Shares or stocks right offerings. Basically, it's the same as FOOs, except it is not open to the public. It's only open to those who have shares already. So only open to those who have shares. So let's do an SRO for stock ABC. So if ABC is trading at $100, they would launch an SRO at, let's say they would sell 1 million shares at like, let's say $95. And so the only people that can participate in this offer that they're offering is the people that currently have the stock. And shareholders are only diluted if they don't take this offer. Or they could only be diluted if they don't take the offer. So existing shareholders are only diluted if they don't take this offer. Now, shareholders are not diluted. They're not diluted if the company sells its shares like from their treasury. They take the offer. So the main difference is that SROs, they protect the current investors by letting them kind of get like a VIP treatment on the offer. So they get it before the public. And so that's about it. Hopefully you learned something today, and peace out.